All right. Well, good afternoon, everybody. It's great to be here with you today. Appreciate you taking some time out of your busy week to join me here with our Stock Investing for Beginners webcast. We are in lesson 8 of our 8 lesson series. The bell just closed and the market is closing just now. We hear the bell. Give a shout out to Eva and Lawrence and Simone and Scott Luck and Gary and Sharon, JDL, and everybody that's here today. Appreciate you taking the time to share it with me. One of my favorite topics today actually is how to exit the trades. The formal title is how to manage the portfolio or managing the portfolio, but we're going to be talking about exits specifically today. Some different types of styles of investing and how they might incorporate different types of exits into their investing decisions. Give a shout out to Brent Morse, who's there in the chat. If you have some questions, feel free to chat those in and Brent will take care of those for you. Before we get started, remind everybody that our presentation today is for educational purposes only, not a recommendation or endorsement of any particular strategy or in stock that we look at today. We do take a look at stop orders. There's no guarantee that the execution of a stop order will be at or near the stop price. Prices could gap over your stop and then you get filled at a much lower price. We are using the paper money platform, so we'll show that. And there are some significant differences between the paper money and the real money. So be aware of that as well. As always, all investing involves risk, including the loss of principal, and past performance of whatever you're using is no guarantee of future success. So our lessons are right here. These are the 8 lessons that we've gone through. Like I said, again, we're on lesson 8, managing the portfolio, strategies, and when to sell. Um, Let me show you where those are on our YouTube channel first. So if you go to the Trader Talks YouTube channel, I'll go ahead and chat this link in. I'm sure Brent can do it as well. But on our homepage, these 8 lessons are found. Just they'll scroll down a little bit in stock investing basics. And this is those 8 lessons that we're going over. So you can review those here, or you can go over to our playlist page, click playlists, and scroll down a little bit. And we're just right here. These are the stock investing for beginners, all of the webcasts that we've done over the last now over a year of using this kind of methodology that I've been sharing with everybody. So you can stock investing for beginners playlist is available as well. And that's what this one looks like here. And so again, if you haven't subscribed to our YouTube channel, we appreciate that. And then also if you click the thumbs up, it's kind of like giving applause to the instructor. So anyway, we'd love to see that. Let me go ahead and go through our agenda today. Um, we're going to take a look at some different types of exits. We're going to talk about rebalancing a little bit. We'll talk about buy and hold. We'll talk about stops and targets and how those may, differ for the different investing styles. We're going to talk about when to sell, some different stop orders. I had a class earlier this morning where I was in chat and someone asked about setting stops. So we're going to cover that in detail today. And then we'll review our open positions. We have quite a few slides to go through for today, so I'll go through those fairly quickly. Again, remember this is being recorded, so you can go back and watch those. But just a lot of interesting and I think useful points to understand, especially if you're new to investing, which is what this class is really all about. If you have some children or grandchildren that are looking to get involved in the stock market, please share these 8 lessons with them. I wish somebody had done that for me when I was in my late teens and early 20s. I didn't learn about this until I was actually in my 30s. And so a little bit later start on my investing journey. But what a wonderful gift you can give to your children and grandchildren to help them understand and learn about the stock market. So, all right, so let's jump in with number 1. This is just a little dialogue. We've been doing this the last couple of weeks, having a dialogue between me, the instructor, and really it's between me and my old self. I might have said something like, hey, I have some nice profit on some of my stocks. When do I sell? So just curious for you guys, how many of you have had this question, where you're looking at a profit on a stock, you didn't really enter the trade with a big plan, but now you're sitting on a profit and you think, okay, maybe I should sell. When should I sell? My answer to that today would be this. Well, it depends. What type of trader investment are you trying to do? And this was my typical response early on. Well, I just wanted to make some money on it. Well, let's look at how different investors plan their exits. And again, you might find yourself doing a mix of these things. You can have part of your portfolio that's just pure investing, where you're really not doing a whole lot of activity with that. And then you might have a part of your portfolio that's what we call maybe more actively managed, or you're trading a little bit more frequently based on a set of rules. One of the little mantras that we have here at Charles Schwab is investors trade and traders invest. And I don't think you have to be one or the other. I think most of us probably feel more comfortable doing a little bit of a mix of both. So let's jump in here first and take a look at some common exits. There's lots of different ways that people use to exit trades. If you're more fundamentally based, they might look at change in those company fundamentals, like drop in earnings, cash flow, or their revenue, or something fundamentally driven. If that changes, that could be an exit for those maybe longer term investors. Some are more technically based, where they're looking at price action, and they'll decide, when they get in, it's like, well, it's trading at $50. If it goes below 45, then I'm going to get out. And then a target, and we talk about this quite a bit in our webcast, because our methodology, the two green arrow plan or sample investing plan that I shared, back in lesson 4, is more of an intermediate to longer term type of investing plan. And there isn't a target per se. We have a method of moving our stop up. And after some time of being in the trade, that stop gets above our purchase price, which is how we attempt to lock in some of those profits, which of course never guaranteed, because the stop could, get filled much lower than what we anticipate. But targets are what you would look for a particular profit point on an investment or trade. And then I see some comments in there. It's like, when do I sell? Never. Well, some people are buy and hold. We're going to talk about that a little bit today. And so, talk about what type of trader you are there in the chat. I'd love to see or hear what you type of investor you are. If you're a pure investor or a pure trader or somewhere in between, love to hear that. So chat that in as we take a look at these exits now. Now, growth investors and traders, okay, these are that more active people. They'll have an entry signal. They'll have an exit strategy. They often will incorporate price targets and stop losses. Value investors or income investors, they might be longer term. They might use what's called a buy and hold strategy and rebalance their positions over time. Okay, and we're going to talk about those two terms. Now, rebalancing is just what it sounds like. You start off the process of allocating your assets by some method. And so, the start of that rebalancing is being aware of what that method is. And then what happens is you sell a portion of those investments that have grown to be a larger percentage of the portfolio, and use those proceeds to buy more investments that have become a smaller percentage, or maybe to invest in new positions there. But the idea is you're going to be rebalancing or selling part and maybe buying part of that portfolio. The purpose here is to prevent your portfolio from drifting into a higher risk level. For example, if the portfolio started off with a 60% stock and a 40% bond mix, as the stocks maybe grew, that percentage goes more like 65-35, 70-30 in that idea. All right. So, how often do people rebalance? Well, a lot of people, if they do the rebalancing, are doing this annually. Quarterly is probably a lot more frequently than most do, but semi-annually or annually is pretty common. Or they might have a percentage if their portfolio's drifted into a different allocation. They might, that might happen in 9 months one year. It might happen, in 12 months in another year, or 3 months in a different year. All right. But also remember that asset allocation and rebalancing strategies do not ensure a profit, and they don't protect against losses in a declining market. When the market gets really bearish or goes down a lot, most everything goes down a lot. All right. So be aware of that. Now, here's an example. If the stocks perform well, you make up 70% of the portfolio that was supposed to be only 60%. Well, you'd sell some of those stocks and perhaps allocate some more to bonds to get that balance back to 60-40. All right. Now, buy and hold is just what it sounds like. A long-term investment strategy that you buy assets and hold them for an extended period. Regardless of what's going on in the news, regardless of what's going on short term, regardless of how you feel that day, regardless of the earnings, all of that stuff, you just ignore it. And that can be really comforting for a lot of people. They'll buy something and hold it. Their plan is to buy and hold for a minimum of 10 years, 20 years, something like that. All right. And the way it works is you're purchasing assets with that expectation of long-term appreciation, and you ignore what's going on daily, you ignore what's going on even monthly, or maybe even quarterly. As long as that stock still meets your minimum criteria, then you're going to stay with that company. All right. The purpose here, now think about it, as you start to discover, now if you're brand new, you may not know what type of investor you want to be. So, you can explore and do some of these different things in your paper money account. And that's a great practice. In fact, I'd encourage you to, try all of these in your paper money. Try a little bit of that paper money portfolio as buy and hold. Try some of that as maybe some shorter term trades with targets and stops, and then try some of them with more like an investing plan like we do with our two green arrow system. But the purpose there of buy and hold is to benefit from the long-term market growth, the power of compounding. See, some people will continue to invest. They buy more stock every quarter or every year. They invest money every month if you're in a retirement type of account or something like that. Every couple of weeks, every time you get a paycheck, you might be allocating money to that type of portfolio. All right. Now, how long is the time frame? Well, long term, years, maybe even decades, where you just are following a plan. And that the only thing you have to worry about is just being consistent and probably not take a look at the market too often because the ups and downs tend to get us emotional sometimes. All right. Now, how do people do this? Well, certainly they can buy individual stocks, but a lot of people will buy what's called a broad market index fund. They hold them through the bullish markets, they hold them through the bearish markets, the up and down markets, and then they really only sell them, and they might not even sell it then, is when they retire, if they need the capital or something for to spend cash, right? So that's a buy and hold. Now, trading with stops and targets is a little bit different. If we have a stop and a target, number one, write this down in your notes, okay? Every short-term trade should have a target, okay? In my opinion, as a trader myself, if you don't have a target on your short-term trade, then it's really not a short-term trade. It's a mix, and those are more difficult. If you've ever been in a trade and you kind of thought, well, I might sell this at 20, and the stock goes up to $20, and you think, wow, this is really going well. And then, it starts to go maybe the next day's at 21, and you're thinking, oh, good, I'm glad I stayed in this trade. But the next day it's at 19, and you think, oh, dang it. Well, as soon as it gets back to 20, what's your thought? Well, as soon as it get back up to 20, I'm going to sell it. And then the next day it's at 18, the next day it's at 17, the next day it's at $3, right? Have you ever known anybody that's gone through that? Well, one of the rules of thumb for a trader is when they hit the target, they take their profit, and anything above that's not their money. That's a way to think about it. My profit's at 20. If it goes to 22, so be it. That's not my money, right? So active trading strategy that uses predefined rules to exit position to either lock in profit or cut losses. Same thing on the downside. You might get into a trade figuring it's going to be a winning trade. Obviously, we wouldn't take the trade if we didn't think it had a potential for profit, but sometimes something changes after we get in, right? Stock doesn't go up to 20, it drops to 18 immediately, or it drops down to, $10. So we want to have an exit to the downside as well. And so you're setting these specific stop losses and profits, you know, at the time you enter the trade. You want to have these in mind. All right. Now, the reason that we do this, or the purpose behind it, is to manage your risk, number one, and manage your emotional decision making. Remember, last week and on lesson 3, we talked about investor psychology a little bit, and it's designed to help you capture gains before a market pullback, limit downside risk, but really it's helping you control your emotions because, if you take a devastating loss, it's very difficult to put that next trade on and you just are incapable actually of taking action if you're uncomfortable with that risk. All right. And then, as we mentioned, there's no guarantee that the execution of the stop will be at or near the stop price. It's just a mechanism or a trading strategy that we use to try to get us out if the stock's moving against us. And, it could gap over our stop and we lose more than expected. All right. Sorry, Pickle Pug, calling you out. I'm really calling me out. These are things that, when I put this slide deck together, I was really thinking about those first days, that first month, that first year or two that I was trading, and just really wish somebody would have told me some of these things in the beginning. All right. So trading with stops and targets, the time frame for that I would say is more like short to medium term. How long is short? Short term typically is like less than 30 days. Some people will go up into that 2 month range. And so 30 days to 3 months, you start getting into that medium term, which is about 3 to 9 months. Some people will call it 6 months, but basically, that medium term is 3 to 9 months, and then 9 to 12 months, we start getting into what generally is referred to as longer term. And, of course, we expect the market to go up and down. We're not expecting the stock to go up every single day or down every single day. Um, but, trading with stops and targets, we're trying to catch different types of moves in our portfolio. Excuse me just a minute. All right. So, an example here is we're buying a stock at $50, maybe put a stop loss at 47 and a profit target of 55 or something like that. Um, and some traders will look, if you're looking at the numbers here and you've traded a little bit, you think, well, that's not a very good reward to risk ratio. It's just an example. But people, when they're doing stops and targets, might try to get 2 times or 3 times the amount of money they're putting at risk in order to you know, not have to be right all the time or not have to have a profitable trade every time they're there. All right. Now let's talk briefly here about different type of stop orders. I want to go through these fairly quickly, and then we want to take a look and spend the rest of our time looking at our open positions in our paper money account and employing some of these stop techniques. And then we'll look at a couple new trades if we have some time. All right. And JJ saying it's hard to put a stop loss in a market like NDX or SPY where the stop loss orders are not active after trading hours, is it not? Well, most of the stop orders that you do and the ones that we use are good during the market hours. So a very close stop, yes, I think you would have a problem with that there, JJ. But if you're employing the rules that we use, which I'll review those when we get to our paper money account, even earnings, there's a lot of times where the earnings gap up or gap down may not hit our stop the way that we use them in our two green arrow plan. So let's go over these different types of stops, and then we'll come back around and answer some questions too. All right, so fixed stops. Fixed stops are just like what they sound like. Break down into two types, dollar amount or percentage amount. If we bought something at 74.50 and we wanted to have a stop at $5 away, our stop would be at 69.50 and it would just stay there until we moved it. All right. A percentage amount, we might be risking, say, 10%. We put a stop at 67.05. That's risking 10% of that initial purchase, and it would just stay there until it gets changed. Now, that's the type of stop that we're generally using, a fixed stop. And I'll show you the rule for that when we get there. All right. Now, trailing stops, many of you may have heard of a trailing stop. And usually the first experience that people have with a trailing stop is they hate trailing stops. Trailing stops are just what they sound like. They trail a price by a certain amount. But what people tend to do is they put that stop too close. Maybe they trail it by $1 or 3% or something like that. And what happens inevitably is they get stopped out before the stock's had a chance to really do anything. So, the trailing stop adjusts to the highest price the stock has. So, for example, here, if we set a stop 10% below the purchase price, the stock bounces around a little bit. In this case, it went from about 74 down to about 72, which is a very small percentage drop. So it didn't come near that 10% stop. And then as it makes a new high, the stop would be adjust up by that 10%. And then it would stay there until a new high is achieved. It stay there until a new high is achieved. And then when a new high is achieved, that trailing stop keeps moving. Now, one of the ways that people use a trailing stop that I find really interesting is after they've achieved, let's say a medium target type of goal. Just as an example, and this isn't on the slide here, but let's say that I buy a stock at $40 and I have a target of 50. Well, let's say it's now at $48. And I say to myself, well, my original stop was down at $38 below the 40 purchase price. And now I'm only $2 away from hitting my $50 target. And do I want to risk from 48 down to 38? Do I want to risk that $10 to make that last $2 of my short-term trade with that target at 50? And the answer to that's probably no. The very worst case scenario is I might move my stop up to break even because I don't want to lose money on a trade now that I've got $8 of profit. But some people would say, you know what? I'm going to do a trailing stop at $2. I'll put a stop, the stock's at 48. I'll put a trailing stop at 2 and try to let it hit that target. And if it, goes down before hitting 50, then I get stopped out and I still have a nice little profit on my trade while trying to allow it to hit the target. Does that make sense? So that's a technique that some people will use for that trailing stop. Or there's one other instance that I really like for the trailing stop is let's say that you're in that same scenario where you have a $50 target and you notice JJ for you particularly because you're familiar with the pre-market or aftermarket hours, you're looking at your stock and it's gonna open. You look at the pre-market quotes and it's saying $52 or $55. Maybe it gapped up on some good news. And so you say to yourself, well, I was happy getting out at 50, but if this thing opens at 52, I'll go ahead and put a $2 trailing stop on this, and we'll just see if it has a day like the market did yesterday, where it just keeps going up and up and up, right? So those are some ways that you could use the trailing stop and be aware of those. All right. And these are again for illustrative purposes only. Now, resistance and support are some other ideas that are important. We talked about these in our technical analysis review, which I think is lesson 6. But a lot of traders will use support and resistance for stops and targets. Support's an area where the price has gone down to and then rallied up from. You'll think of it as a floor. And so they might set a stop below support. Resistance, on the other hand, is like a ceiling. The price goes up and hits a particular price, gets pushed back down, goes up to that price again, gets pushed back down. We call that resistance. And so those ranges are often used for stops and targets. So when we set a stop price below support, it's pretty common to use somewhere between about 2 and 5%, depending on the price of that stock. How expensive is it? All right. 3%. Technical traders often believe that a support or a resistance level is not broken unless it breaks by 3% or more. And so if you heard that 2 or 3% type of idea, that's what we're trying to do, is let the stock have a little bit of wiggle room in those areas without knocking us out of the trade. And we've done that many times in our 2 green arrow. One of the checks that we use is we say, okay, I've got a red arrow here on the MACD. I've got a red arrow on my moving average. I'm supposed to adjust my stop up. And what we always ask is, does this stop make sense? Meaning, is it below or above the previous support level? And so, it's very frustrating. Just as an example, if this support level on our slide was at $50 and we have a stop at $51, that's what our rule says. Well, you'd say, well, I don't really want to get stopped out at 51 if support's at 50, so I'm going to move my stop down below that support area by, 2 or 3, 4, 5%, whatever it is. All right. Now, support can also be diagonal. We draw trend lines in an uptrend. We take a look at the different lows, and then we just try to connect those. And so that's a diagonal or rising support line, and people might, move their stop up or keep their stop somewhere below that support line. It could be, again, that 2 to 5% below that, and they would adjust that stop. Now, put this down in your notes. This is when they adjust the stop. When new higher levels of support are established, we don't really want to jeopardize our longer term position by moving our stop up too quickly. All right. Now, again, this is not talking about target exits, it's talking about stop management. All right. So that's an important concept. The other one here is with your moving averages, technical stops. They might use a moving average. That's what we're doing in our two green arrow plan. Moving average is just a trend following indicator that shows average value of a stock's price over a set period. Generally used to measure momentum, defines area of possible support and resistance. In an uptrend, you can kind of see that moving average acts as support. You might hear me or another coach talk about the stock price has bounced off support. That's when or bounced off the moving average, like a 50-day moving average or a 200-day moving average. In a downtrend, you can kind of see on the right side of this slide is that when the stock's downtrending, it might rally up to that moving average and then fall back down. Sometimes those moving averages will act as resistance. All right. Now, the last little part here I want to cover on the slides is talking about our targets, and then I'll come back around and look at the questions here for us individually. But let me get through this material first. All right. So when do we sell? Well, price targets are typically based on two things. Number one, previous price movements or what's called a price pattern. For example, if a stock broke resistance, then moved up about 10% before consolidating again or trading sideways, traders might set an exit near a similar move in price. We looked at some resistance and support levels on a chart. If we buy near support, then that resistance level might be a potential target that traders look for. And the whole key here for this lesson 8 is what? Know your exit before you enter the position. Why do we do that? Well, our brain tends to work really well before we get into something. I'm going to buy this stock and make a gob of money on it. That's my plan. Well, as soon as you buy it without really a set exit rule, as soon as that thing wiggles around a little bit or pulls back a little bit, traders or some people, new people, tend to panic a little bit and they take their profit. Now, let me ask a question. How many of you have gotten out of a trade because you thought it was going down, you got out, and then by the end of the day or the end of the week, the stock not only didn't go down, but it's up dramatically, but you're not in it anymore? Well, yeah, that was my world too. So this happens to people a lot, all right? Is where, if you can plan your exit before you get in, it's a lot easier to manage your emotions and to manage your stock portfolio. So let's do this. Let's jump over to Thinkorswim here. And what I've got here are our open two green arrow trades. Now, if you're brand new, this was the first class you've ever been to, I'll show you a chart here in a minute. But our rule of thumb, okay, is we're using a 50-period simple moving average and we're using a MACD histogram to help us see momentum. And when both of those have green arrows on them, which I'll show you again in the chart in just a moment, we consider that a valid buy signal. And we set our stop 1% below the 50-period moving average. Now, on the stocks we look at today, you might think, wow, that's a long way away. I don't want to set my stop that far away. Well, again, the objective of this particular investing plan is to try to buy and hold the stocks through the short terms up and downs and even some of the intermediate up and downs so that we can try to stay in that trend intermediate to longer term. And we're using that 50-period moving average as an intermediate to long-term kind of general support area when we buy these stocks. And so if the trend doesn't go down dramatically for very long, we'll stay in the trade. If it does change, though, it will knock us out of the trade. And we'll take a look at some of those. Now, before I look at these here, what I want to do is just throw out a question, because one of the questions that has come up many times over the last year that we've been doing this two green arrow plan together is, where's your target? Well, as I mentioned earlier, there really isn't a target. And I've looked at all of the trades that we've done. I've been trying to figure out, because so many of you ask about it. Well, if there is a target price, where should that target price be? And so what I want you to do right now for me is just look at these percentage gains that we have on these are the P&L open, or the P&L percent gains that we have on our open sample stock trades. We're up 5% on ABT that we got in recently. If I click on the P&L open, you can see the date. So like we bought this one a couple weeks ago. Cisco, on the other hand, is up 82.5%. And we bought Cisco back in June of 25. Okay. And then we don't have really any profit on DG, 7% on Ford, 16% on GE, 3% on Coke, 14% on Met, and so on. So my question to you is, where would you choose to exit your stock trades? And then the reason I want you to look at that P&L percent column is because the challenge with exiting a trade at a certain percentage is that you can't make any more on that particular trade, right? If, for example, we've got a whole bunch of these that are sitting at 14%, 13% or whatever. What if we exited all of these at 10% profit, which isn't bad? I mean, the markets generally have returned over the last 100 years somewhere between 8 and 10%. So, if we're taking profit on our GEs and our Mets and our MMMs and our Ross stores, when it hits 10%, you know, we do okay on some of those, right? Well, then we'd never get an 82% gain. We'd never see a 56% gain on a particular stock. So, one of the things I want you to think about when you're looking at targeting is in an intermediate to longer term type of investment, not a trade, but more of an investment, which is the type of investments we're trying to do in this webcast, is we don't have an upside target. We want to be in the trade for years if we can. All right. And we've talked about that a little bit, but one of the things that's pretty common is I have seen when we get up near that 14 to 20% range with the stocks that we've traded in the S&P 100, it starts bouncing around and tends to go sideways. And so here's my rule of thumb, okay? And I want you to adopt or at least think about this rule, okay? If you're going to take profit on your trades, then you must be willing to re-enter that position at a higher price. Okay, let me say that again. If you're going to take profit on GE when it hits 16%, and let's just say that's trading at $370 at the time, then you get a new buy signal when it's at 380. You need to be willing to retake that position, as a trader. Okay. And so, just incorporate some of these ideas into the, hey, AE, welcome. Glad you're here. When you're looking at that. All right, let's go look at a chart first, and then we're going to take a look if we have time. I want to show one trade for sure. We'll put a trade on here, go through the rules, and we'll show you how to set a stop loss there. I see a question from Justice, you're the one that was in the chat, so I'm glad you're here. Thank you. But let's go to the chart here. And so this chart, now the link, if you want to have this same chart, the link for this chart is in the description of this webcast right now. So you can open that up and grab that. But what we have on the chart, the green line is a 50-period simple moving average. The purple line or dashed line is a 1% moving average envelope. And that's where we're setting our initial stop order. And then we have an 817.9. Those are the time frames for the MACD. And the MACD stands for moving average convergence divergence. And really just think of it as momentum. When it's rising, the price of the stock's usually rising. When it's falling, the price of the stock is either slowing down or perhaps even dropping, and so on. But our buy signal is when both the stock price is above the moving average, so that's a green arrow. Like that green arrow happened way back here on the 4th of June on Wells Fargo. And that green arrow is green until it turns red. So as long as the price is above the moving average, we're going to say that's a green arrow. And the MACD, you can see, just turned green yesterday. And it will follow through today. So let me go back a couple days here. This is partly for those of you that are new. This is what we call getting ready. if I had Wells Fargo in my watch list and I'm thinking, okay, I'm getting ready to buy it. I can see the stock's had some trouble. What do we call this line up here where it's been banging its head there about 88.50? What do we call that? Remember? It's called resistance. And then when it comes down to a level like in this case, $83.83 or so, this is an area we call that support. So we might be looking at this, we think, oh, this has got a green arrow on the moving average, and the moving average is rising, which is one of our criteria. And we say to ourselves, okay, what would have to happen tomorrow for me to buy this stock? Well, if I look at the MACD, I could say to myself, well, if the MACD turns green tomorrow, okay, and it gives me this little green arrow, which is where we get our two green arrow name from, our nom de plume, right? So I might say to myself, Scott, what would have to happen tomorrow for me to take action and buy Wells Fargo? Well, if I'm following my two green arrow plan, I would just say, well, the MACD turns green. Okay, so I move the chart forward and I say the MACD just turned green. Okay, so right there is a valid buy signal based on our sample investing plan right there. Now, those of you that have been around for a little while and looked through, lots of our webcasts, what's the problem with buying right there? Any worries about buying right there at the closing price, which was about 88.39? What's the problem? Well, the problem is, is we're still below resistance. Last time it hit resistance, it went back down $5. I don't want to be in that boat. I don't want to get in here at 88 and change and then have it go down to 83. So some people will say, well, I'm going to buy it if it has two green arrows and it closes above resistance. So let's go back a day again. Let's walk through this. Okay, so now I ask myself, I can see the resistance. So I say, Scott, what would have to happen tomorrow for me to buy Wells Fargo? And I would say, well, it has to give me a green arrow on the MACD. So we're red right now. That's not a buy signal based on my rules. And I can see I've got some pretty strong resistance at 88.50. So I would have two criteria. I would say I need a green arrow on the MACD and I need to close above 88.50. So I go forward and I say, okay, is this a buy signal? Do I take action right here? And the answer is no. I can see the green arrow. Now I have a green arrow on the MACD. I have a green arrow on the stock because the stock price is above the moving average, but it didn't close above resistance, so I'm going to wait. What am I waiting for? Close above resistance. Next day, which happens to be today, and it closed at 89.17. Okay, so this is a valid buy signal, so I want to go ahead and buy this. Now, so I think Justice, you were asking about how to set a stop. So here's a really easy way. On the chart, you can just right click, do a buy custom with a stop. Let me shrink this side over here down. And if I put my cursor right there on that purplish line, I can see 83.34 is where that 1% below the moving average. That's our stop rule. So 83.34. And I'm just manually setting that stop. I don't want it to move around. 83, what was it? 70.34. Okay. And I want that stop order to be good till canceled. And I'm going to put a limit order to buy this right at the closing price of 89.17. Okay. So that's what we do to get the order set up the right way. Then we want to decide, well, how many shares can I buy? Well, we talked last time about buying $500 or less divided by the purchase price, 89.17, and that would be 5.6 shares. So we could do 5 shares. All right. The last check that we want to do is if I buy 5 shares and I buy it at 89.17 and it goes down to 83, I'm risking about $6 per share. $6 times $5 is $30. So my question would be, am I willing to lose $30 on this Wells Fargo trade? The answer to that's yes, which in our case it is because we're willing to lose up to $50 per trade. Then we could do this trade. And I'm going to hit confirm and send and review the order. It says confirm and send, not send and send. So buy 5 shares at 89.17 limit, sell 5 shares at 83.34. That's a stop order. Now we know the stop's not guaranteed to get filled at 83.34, but this is going to trigger a market order and it could fill significantly lower, especially if it gaps over $83 and opens at 81 or 83 or something, or 82, right? And then I'm going to put this in our two green arrow group. And so now we've got that trade setting up for tomorrow. And that's a limit order there. All right. Now, real quick, I've on our open positions here, I have a column called above the 50 period moving average, and I have a column here for the MACD, and it just tells me what the status is. So this 43, for example, on Wells Fargo, that means for 43 days, it's had a green arrow on the moving average. Now F looks like it has a red number here or a red. Let's take a look at Ford because Ford looks like it closed below the moving average. So it closed below it here. And so based on our rules, we have something to do. So, and I probably should have done this a little bit earlier, but yesterday, that's our second red arrow. Do you see that? We closed below the moving average on the third. We went down yesterday and got a red arrow on the MACD. And so, Justice, again, for you, thanks again for joining us. The stop adjustment rule that we have after getting in our initial stop, which is 1% below the 50 period moving average, we look to adjust the stop when we get red arrows on the trend or on these indicators. And so the low price that day was $13.98. So our rule says to put the stop 3% below 13.98, the low price on that red arrow day times 0.97. That's what we get for our stop number. And the rule says to put the stop at 1356. So I'm just going to draw a line just like right here, and then I'm going to right click on it and put it right at 1356. Now, the reason I'm doing it this way is the rule says to put the stop 3% below the support or below the low price on that third red arrow day. But our check says what? Those of you that have been with me for a little bit, what's the check that we use? Well, is this stop, is this yellow line above a known support area? Well, obviously it's below the 1380 support, but what do you notice about these lows right over here? You guys see those? Let me draw just a horizontal line on those. So here's kind of the extreme low of that support level at 1322. And so here's the question that we're asking. The rule says to put the stop there at 1356. I know I can see a support level at 1322. And my question that I would ask is, do I want to get stopped out at 1356, see it hold or stay above 1322, and then go back up again? My answer to that is no, I don't want to get stopped out a little bit above this support level. So probably what some traders would do is they would recognize the rule. They see the rule, right? The rule says put the stop 3% below that second red arrow day. But because we have support here, they might adjust their stop to somewhere below this. And we could use 1 to 3% or 5% below there. You know, I'm already below my rule. So for me, a lot of times 1 or 2% is fine. So let's take 1322 times 0.98 for 2% below that because it's such a cheap stock, 12.95. And so I'm going to move my stop up to 12.95. And check this out. Right click or left click on that and hold it, drag it up a little bit, and we could say 1290, that's 97, and then I'll edit it. 1295 is our stop. Again, no guarantee to get filled at 1295, could gap over that. We send that off, and now I've adjusted my stop up based on my rules. All right. Okay. Well, I do see some questions in there. I see some of those. Looks like there's also a survey in here. Now, because we're essentially out of time right now, what I'll do is I'll go back through the chats and I will put answers to your questions in addition to the ones Brent's already answered, because a lot of those are really useful for the other people, but they'll be in the YouTube comments for this webcast. And if you go back and look at those other webcasts that I've done on our playlist, just as an example, let's go take a look at this one here. But you can see here what I'll do is I'll either put questions from the survey. You know, this one was how do I set stops? Question from the survey, question from the live webcast. So I'll post these on the recording for this webcast, which will be found, in our Stock Investing for Beginners playlist. So you can see those answers because I wanted to cover some certain things today, and I didn't get a chance to answer all those questions. I answered a few of them, but you know, in this case here, I'll post those answers in the recorded archive. So hopefully that was helpful for you today. We'll wrap up by just taking a look here. What did we do? We looked at those common exit. We talked about rebalancing. We talked about different strategies. We talked about different stop order techniques. We talked about our open positions a little bit. We did a sample trade there on Wells Fargo. And so, my goal for you today is really just to decide, what type of exit you want to use for your different strategies. And it's okay to have a couple different strategies. You might have a short-term trade, you might have a longer-term investment, and just decide today or this week what that strategy is. So again, thanks for being here, everybody. Have a great day. We'll see you next time.